Hey everyone, welcome back to Corporate Dakota, the place where we unpack the financial secrets that big companies try to hide in plain sight. Today we're diving deep into a semi-annual report that is packed with information on investment strategies. We will be looking at Starboard Investment Trust's latest report, specifically focusing on two funds: the Matisse Discounted Closed-End Fund Strategy and the Matisse Discounted Bond CF Strategy. This report covers the period from the 1st of April 2025 to the 30th of September 2025. If you appreciate getting straightforward, no-nonsense financial breakdowns, make sure you are subscribed. Also, join our growing community on Discord. The link is in the description below. So what exactly are these funds up to? We're talking about investment companies that aim to make money by investing in other investment companies, particularly closed-end funds. These are funds that often trade at a price lower than the value of their underlying assets. The idea is to buy these discounted funds, hoping their value goes up or they pay out steady income. First off, let's look at costs, because nobody likes paying too much. For a hypothetical $10,000 investment in the Matisse Discounted Closed End Fund Strategy, the costs over these 6 months were about $84, which works out to 1.51%. Not too alarming, but it is always good to see these numbers. Now, for the big picture, as of the 30th of September 2025, the Matisse Discounted Closed End Fund Strategy had net assets totaling a whopping $66,906,914. That is a lot of money being managed. The fund held 39 different investments. Let's peek at where that money is going. The top holdings give us a clue about the fund's focus. Tetragon Financial Group Ltd is the largest single holding, making up 9.2% of the net assets. Then we see Pershing Square Holdings Ltd Fund at 6.5%, Taiwan Fund Inc. at 4.2%. and China Fund Inc. at 4.1%. These are significant chunks showing a focus on specific companies and regions. Now, let's switch gears to the Matisse Discounted Bond CF strategy. This fund has a similar approach, but with a focus on bonds. The goal here is to generate total return with an emphasis on income. They mostly invest in closed-end bond funds. For a $10,000 investment in this bond strategy, the costs over the same 6-month period were around $64, which is 1.24%. This is slightly lower than the equity-focused strategy, which can be a positive for investors. The Matisse Discounted Bond CF strategy had net assets of about $51.5 million. It held 27 different investments. Looking at the bond strategy's top holdings, we see a very different picture. Fidelity Government Portfolio is by far the largest, making up a massive 38.6% of net assets. This indicates a strong leaning towards us government-backed investments, likely for stability. Other major holdings include PIMCO California Municipal Income Fund at 10% and PIMCO New York Municipal Income Fund, the SU, at 8.3%. The concentration in government and municipal bonds suggests a defensive posture. Let's dive into the actual financial statements for the Matisse Discounted Closed-End Fund Strategy. The investments at value were over $67 million. Total assets were over $67 million. And total liabilities were just over $1 million. This leaves net assets of that $66.9 million we saw earlier. Looking at the statement of operations, we see the income and expenses for the closed-end fund strategy. Investment income was over $1.4 million. Expenses were around $438,000. That leaves a net investment income of over $1 million. But the real story is in the gains. They had a net realized gain from investment transactions of over $1.2 million, and a very significant net change in unrealized appreciation on investments of over $7.2 million. This led to a total net increase in net assets from operations of nearly $9.5 million. When we look at the changes in net assets, the closed-end fund strategy saw a big jump. Operations contributed over $9.4 million. Distributions to shareholders were negative $2 million, meaning they paid out less than they earned in income. Capital share transactions, meaning shares sold and repurchased, added over $8 million. All this resulted in a significant increase of over $15.5 million in net assets for this period. For the discounted bond CF strategy, investment income was also strong, over $1.4 million. Expenses were lower, around $326,000, resulting in a net investment income of over $1.1 million. They also had a net realized gain from investment transactions of over $1.6 million. However, they experienced a net change in unrealized loss on investments of over $1.4 million. This brought their total net increase in net assets from operations to just over $1.3 million. In the statements of changes in net assets for the Bond CF strategy, operations added about $1.3 million. Distributions were over $1.8 million, which was a decrease. But capital share transactions showed a net decrease of nearly $2.5 million, meaning more shares were repurchased than sold. This led to an overall net decrease of nearly $3 million in net assets for this fund. This suggests more money flowed out than in, despite positive operational performance. The financial highlights give us a per share view. For the Matisse discounted closed-end fund strategy, the net asset value per share grew from $6.82 to $7.99. The total return for this period was a very strong 21.39%. This clearly shows the impact of that large unrealized gain. For the bond CEF strategy, the net asset value per share increased from $10.49 to $10.64. The total return for this period was just 5.07%. This is a much more modest return, reflecting the larger unrealized loss and the more conservative nature of its holdings, like government bonds. The expense ratios here are also worth noting. For the closed-end fund strategy, the net expenses were 1.51%. For the bond CF strategy, the net expenses were 1.24%. Now, let's talk about risks. The report details quite a few. For both funds, there is a significant risk associated with investing in closed-end funds themselves. This means the funds that these strategies invest in can trade at prices different from their actual value, meaning the value can swing quite a bit. There is also control risk, meaning the managers of these strategies don't actually control the investments within the closed-end funds they buy. Then we see risks like convertible securities and equity securities risk for the closed-end fund strategy. This means they are exposed to the ups and downs of the stock market. For the bond CF strategy, there is a strong emphasis on fixed income securities risk, which is all about how interest rate changes can impact the value of bonds. Interestingly, both funds highlight cybersecurity risk. This isn't just about the companies they invest in, but also about the operational risks to the fund itself and its managers from potential cyber attacks. Given the amount of sensitive financial data involved, this is a crucial point. You also see foreign securities risk for both, implying that while they might be focused on discounted closed-end funds, some of those underlying funds invest internationally. A big one for both is fund of funds risk. This simply means that by investing in other funds, investors are essentially paying two layers of fees, the fees for the strategy itself and the fees for the underlying funds. This can eat into returns. And finally, there is investment advisor risk, which is pretty straightforward. It means that the success of the fund heavily depends on the competence of the investment advisor, Matisse Capital in this case. Looking at the tax information, the cost of investments for the closed-end fund strategy was around $51 million, with a net unrealized appreciation of over $500,000. For the bond CF strategy, the cost of investments was higher at over $52.9 million, but with a net unrealized appreciation of about $1.3 million. This shows the different performance profiles of the two strategies. One interesting disclosure is beneficial ownership. It seems Charles Schwab is a major shareholder in both funds, holding a significant percentage of shares. This is important because large block holders can sometimes influence a fund's direction. For the closed-end fund strategy, it was over 69%, and for the bond CF strategy, it was over 78%. On the leadership front, the report mentions that independent trustees receive a modest salary for their oversight. For the period of this report, the aggregate compensation paid to trustees on behalf of the Matisse funds was just under $10,000. No special compensation was paid to officers. And that wraps up our deep dive into this semi-annual report. Now, for my take, the Matisse discounted closed-end fund strategy clearly had a stellar period, largely thanks to a massive surge in unrealized gains. This means the value of their underlying investments increased significantly on paper. The strategy seems to be working as intended, capitalizing on discounts in the closed-end fund market. However, this also highlights the risk associated with chasing such gains, as unrealized means they haven't been locked in yet. The Matisse discounted bond CF strategy, on the other hand, had a much more subdued performance. Its heavy reliance on government and municipal bonds suggests a focus on capital preservation and income, which is a sensible approach in uncertain times. The modest gains and the slight unrealized loss in investments indicate a more stable but less growth-oriented strategy. This is not necessarily bad, it's just a different risk. Reward profile, a key consideration for both, is the fund of funds nature. Investors need to be aware of the double layer of fees, which can really add up. The cybersecurity risk is also a significant modern-day concern that deserves attention. The large stake held by Charles Schwab is also something to watch, as a major shareholder can wield influence. Overall, these funds appear to be executing their stated strategies. The equity-focused fund is delivering growth, albeit with higher volatility and risk, while the bond fund is prioritizing stability and income. Investors should carefully consider their own risk tolerance and investment goals before choosing between these two distinct approaches. Alright, that is our breakdown of Starboard Investment Trust's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.